Welcome and thank you for joining the Nest Egg Show. Today, our guest is Patrick Grimes, and he's going to be talking about investing in litigation funding, non-correlated diversification. Before I tell you about Patrick, I have a little, I guess it's a data point that I ran across this week that surprised me. I was doing some research on some investor portals or whatever, and I just stumbled across this, but it said that 69% of millionaires did not average $100,000 a year or more household income. And a third of them never made $100,000 in a year. And I just thought that was so, so relevant, and people need to be reminded, right, that you don't have to make a whole lot of money to save and invest and to have it accumulate into something. So just wanted to share that with you. And now I will introduce you to Patrick. Patrick has 15 years of experience in active real estate investing, purchasing distressed assets, renovating and stabilizing for long-term cash flow. His portfolio includes controlling ownership over 4,000 units in emerging markets across Texas and the Southeast United States. In addition to his real estate experience, Patrick holds a Bachelor's of Science in Mechanical Engineering from the University of the Pacific and a Master's of Business Administration and a Master of Science in Engineering from San Jose State University. He has spent 15 years in corporate America working for machine design firms to concept design and build one-of-a-kind custom manufacturing, automation, and robotic systems. In addition to working closely with the technical engineering teams, he travels globally working to negotiate contracts and secure a multi-million-dollar investment for automation programs. He has been able to leverage his corporate experience and real estate knowledge to help pave the way for future success. Thank you, Patrick, and welcome to the Nest Egg Builder.
I appreciate you having me, and we had a little bit of a mix-up on the join link, so thanks for your patience as I logged in, and the wonderful intro. We're going to get on and talk about non-correlated investments and investing in recessionary times here in just a minute, but I wanted to say, I said about 20 minutes, I think she said, so what's the time check on that? So are we looking at 35?
Yeah, approximately.
Okay.
Yep.
All right.
We use up the full hour, right, until 3 o'clock. So there's some buffer.
So we'll move as quick as we can. A lot of really good content. Not a massive group, so there should be hopefully some interactivity. I like it when there's questions related to slides that we're on. If you have kind of questions off the map, then I might skim past those and then circle back to them, or I might skim past. We're going to cover it in a second. But I'm very happy to be here and talking about, as we'll reveal in just a minute, we're talking about topics which are very near and dear to my heart, because I have been a high-tech machine design, automation, robotics engineer, probably like many of you, working very hard, slaving away at the job, trying to get ahead. And then I started venturing into real estate, as we'll talk, and I had some ups and I had some downs. And the intention of this is really to talk about my journey from then until now and how I think about investments today. So that's really it. And I'm going to go through some of this. Let me know when you can see the screen.
Okay, we can see the screen.
Okay, and I've got the chat over to the right. Could some people just drop a note in there? Let me know you can hear me, where you're from. So we'll just make sure we got proof of life on the chat there. So, any content in this presentation, we always have to have the disclaimer slide. Is it meant to be a performance measure? And it's important that you meet with your own CPA, attorney, or financial planner, as I'm not an attorney, a CPA, or a financial planner before making any investment decision. So I'm going to talk about why alternative investments, how the wealthy diversify, typical investor progression, which is what I did, and it relates to a lot of other individuals. Jonah calling in from Washington, Jason, Scottsdale, great to have you. And then we're going to talk about high and low correlation explained, and really what does that mean for your portfolio overall. But as Jonah was doing a really great job earlier, she was telling my background. There's me standing in front of the Tesla Model 3 rotor assembly, cell above my forehead, and a COVID diagnostics test. Well, it was first flu and then converted to COVID. And then behind my head is a satellite solar cell assembly. So I was pretty much in the geek space and loving it. Until 2008, I ventured into real estate. I got some advice early on. And then I lost everything. We'll talk about that in a minute. Did a bunch of single family after that, after the downturn into 2009 and 10. Scaled into larger apartments with a company called Invest on Main Street, where I learned to partner. I have about 5,000 units now, about 600 million in partnership, right? For Forbes, got 2 best-selling books and 1 international bestseller. Did some energy before I founded Passive Investing Mastery, which is a company that allows us to do alternative investments. And we have 2 funds that are winning from the downturn and a diversified litigation fund. And we have a pretty expansive portfolio given the short amount of time. And that's our team. I'm going to skip through some of these, but our mission is really to achieve mastery in the art of passive investing, and to do that through educating our investors. And not only to get financial security for our investors, but to get them to abundance where they have the resources for the causes they care about most. We do an every 2-week, bi-weekly alternative investing series, and I bring on all kinds of investment sponsors to that end. And that promo code will get you registered for that bi-weekly series if you're interested in joining. Let's see. So then the next, we have some track record slides in here. I'm going to skip through these. It looks like this is recorded, but we're meeting our projections in our funds right now. So why alternative investments? Really, it's about a balanced portfolio allocation. And I think that there was a turning point in my career. Probably everybody has some version of this, but every year, my brothers, we love to go to Mammoth Ski Resort. Don't know if you know about that one, but it's up in the Sierra Nevadas. We have a great time. It's my favorite trip of the year. But one year, we all jumped in the car and we're doing the long drive out through the Owens Valley to get there. And we're all talking about the successes. A lot of really awesome guys there, the CFOs, general managers, and all kinds of industries. And I was very proud of a project I'd worked on. Ever since Christmas, I'd actually slaved away and dedicated a lot of time away from my family for this project. Contracts were signed, purchase order was signed, down payment on the way. When on that trip up, when I was talking about how this would mean hundreds of thousands of dollars in passive income for my family, on that trip up, the son of the owner for the company I was contracting with made a phone call. He had the customer on the line. He said all the wrong things, destroyed the deal. They retracted everything. I was devastated. And I was tired of having somebody else always have control over the financial future. If I did everything right, I still didn't have control over my financial future. By all measures, though, I was very successful. I've traveled the world. I've done 2 gap years, been through almost a quarter of the world's countries. I've climbed the base camp of Everest, whitewater rafted the Grand Canyon, climbed Fuji, Shasta. I've gone on 24-day backpacking trips. I've done a lot of really cool stuff, but it wasn't enough. I knew that there was more, and I had received some advice. Invest as much as you can in real estate as early as you can. It's strange because that actually came from the co-founder of the company that I worked for, in high-tech automation and robotics. However, he knew that the diversification of the wealthy wasn't into high-tech stocks. He knew, as Joan was pointing out at the beginning, that there are more millionaires created in real estate. And he had been dumping every penny that he had made from this high-tech company, not into stocks like I was, but into real estate. And his regret was not only investing more sooner. And he wasn't purely a real estate guy, but he knew that that's where I needed to get started. He was focusing on allocation strategies to the wealthy. So Passive Investing Mastery, I teach my journey and the allocation of the wealthy and help people skip along the way. As you can see, the middle class at the top there at 7.9% in alternative investments. That's outside of your pension accounts, your personal residence, your stock portfolio, your retirement accounts, not the ones that are self-directed. But when you get to the upper, you get about 24%, but the wealthy have over 50% in alternative investments. And what are those? And if you look at Tiger 21's matrix or pie chart here, it actually shows 27% in real estate, 26% in private equity. So what are those things, right? What are these things outside of real estate, and how many people are allocated and over allocated according to this in real estate? Is anybody over allocated? I can't see hands, but I can probably see the chat. So a lot of investors are feeling over allocated, especially now when there's a downturn happening in real estate. So where do they fulfill this 26% in private equity? And not only is it a downturn in real estate, but we've just seen in the last couple of days some volatility in the stock market. Why? Because the stock market's cyclic and sentiment driven. So allocations of the wealthy look to be on different cycles. And they don't have to worry about things like Fed rate hikes and recessions. Why? Because they're allocated not just into the stock market or real estate, but various assets which don't have the boom and bust all at the same time. Call those non-correlated. Talk about that in a second. The last 14 Fed rate hikes had 11 of them land in a recession. And that's the fear. So if you're over allocated into equities right now in your stock portfolio, probabilistically, you're in a dangerous spot. If you're over allocated in real estate right now, probabilistically, you're in a tough spot. What else? Where else do you go then in those cases? Typical investor progress. And this is my own story, as well as many others. Starting point, employee-sponsored retirement accounts. That's what I did. I maxed it out. I maxed it out, and I had a travel fund. High net worth individuals have over half of their wealth there. Now, many of them allocate into self-directed accounts. It's not just all in equities, but half of their wealth in tax advantage accounts. And I've got articles in Forbes on how to do that, on how to invest in self-direct your IRA, 401k. Now, when they have a surplus, tend to go for IRAs, right? That's another way you can add more. Where it goes sideways is financial planners. I have a lot of friends that are financial planners, and we duel all the time. Why is that? That's because they have this idea that you can be diversified in the stock market. Well, if you're feeling diversified, if you're diversified in the stock market and you're fearful today because you just saw some volatility in the last couple of days, then you're not diversified. Why? Because diversification, if there's any point to it, it's not to buy two things, it's to buy things that don't lose value together. That's true diversification in the recession resilient allocations. So the misconception is that you can diversify in the stock market. And that is what they would have you believe. And the reality is, put everything in 401k or IRA, and they just want to keep it on in their management, and they're only trained in their own specific products because they're investment product salespeople. They don't know anything outside. They don't study allocations of the wealthy. They're only trained in these, and you don't practice selling away. It's literally giving money away from their retirement account. Their annuity is your plan, and their fees off your plan. They don't do that. So what does that mean? It means that you're truly in this sentiment-driven stock market with your portfolio. Or they say, hey, look, we're going to get into REITs. What are REITs? REITs are real estate, right? Got a whole article in Forbes. If you want to hear my opinion on that, you can scan that 2D barcode or click on that link, and you'll understand why REITs are very, very different. Not only do they lack the depreciation or a hedge against inflation, they don't give you the security of a hard asset, but the worst part is it's just paper and it's sentiment driven with the stock market. It is not diversification. It is more of the same. And this graph right here shows that. You can see the S&P 500 is that red line, and the REIT index is that dark black line. And if anything, the REIT index is more volatile, trending with, but on an amplified way, correlated to the S&P 500. That's the ruse of REITs. Unfortunately, that's not diversification. Typically what happens then is people, well, you know what? Okay, I'll do real estate, but I'm going to be a direct owner, right? I want to own something. Well, that's what I did. And I was like going to launch out and do it all on my own. And I didn't know what I was doing. I wanted to do single family. In fact, I wanted to double and triple my money. So I did free development in single family, lost it all. right? I was highly indexed, over leveraged. 2009 and 10 happened. I didn't have any downside protection because I was doing it on my own and personally guaranteeing everything. Lost it all. There's an asset protection issue there, not only from your exposure to loss, but also if your exposure to lawsuits. Single families are not as protected as other forms. And I have a whole article in Forbes, which you can talk about. You can scan there and understand all the ins and outs and what those gurus talking about flippers aren't telling you about the risks, the liabilities associated with the single family journey. When it came crawling back to real estate, I did single family again. But instead of development, I was buying existing assets I could renovate, cash out, refi, and hold, and do it again and again. But I was moonlighting it. I thought this was great, and it was great. And it was working. That was the hardest part because it's not passive at all. I was doing all the jobs myself. It wasn't profitable enough for partners. I was exhausted and burnt, and I had to stop to get married. I literally, my wife was there in Chinatown. We met at a mobile notary for our very last dinner signing on a last single family home. And I said, look, I'm taking a break. And then we got married. And there it is. There's our wedding on the right side, me on a horse with a bow and arrow in Beijing. And there's her with a red dress and a phoenix on it and a carrier on a 20-minute long procession. And then there's us on the beach at our place in Hawaii and our little dog Lily Koi and our little happy life. And we had to make it. But in order to make that happen, I had to pay attention to my family. I had to pay attention to the causes that I cared about and had to stop single family. So then what do? Oftentimes people get into these syndications, right? They think, well, you know what? I can start allocating into real estate syndications. There's positives and negatives to everything. And I've got some articles there that you can scan and read a little more about this. But, I've got some retirement account. I've got some cash. Maybe I can convert it to a self-directed retirement account. It gives me real ownership in real estate. It gives me all the depreciation, hedge against inflation, tax advantage. A limited partner means I have limited downside, which I didn't have before. I lost everything. I have limited legal liability. They can't sue me for everything I'm worth as a limited partner. That's freaking great. I lost control. I had to partner. That's tough. And that's a skill. Not super good at that. I love the cash flow and appreciation and tax advantages and how easy it is to invest with my retirement account. And it's very difficult with single family to invest in your retirement account, but I had to partner. So it took me a long time to figure out how to do that. Actually, it took 2.5 years. David Ramsey says the only ship that won't sail is a partnership. I don't like David Ramsey at pretty much most everything he says. I think the toughest ship to sail is a partnership. I'm not sure if I made that up, but that's my take. And there's me kiteboarding and sailing in Hawaii with my wife and our dog Lily Koi and our new son, 18-month-old Emery. It took a long time for us to be able to get to the point where I found the right partners and I was able to scale through partnering. Scaling through partnering had a lot of advantages, right? It allowed me to leverage more experienced operators. It allowed me to invest in more geographic locations, right? It allowed me to do more asset classes. And I didn't have to become the expert in all. I didn't have to trade away so much of my family, friends, and hobbies for it. And most importantly, it gave me more exposure to other assets outside of real estate that were not correlated, didn't rise and fall with real estate, didn't have the same fundamentals and market cycles, which gave me enhanced portfolio stability. What are those things outside of real estate? We're going to get to that in a second. And commercial real estate has some huge challenges. We can skip through some of this because this really isn't a commercial real estate talk. But we have 2 opportunistic funds, one placing debt right now, which is cash flowing and really strong cash flow at high interest rates for struggling operators. And we have another one that's buying opportunistic commercial real estate right now in cash and great yield. That's a lot of growth. Why is that? Well, here's your first lesson in correlation. Here is the resident median sales price for homes, residential, versus your 30-year mortgage interest rate, right? And there is an inverse correlation here, and there's a latent effect, right? This latent effect means that as interest rates began to rise, it took a little bit longer, but then prices begin to soften. Same thing in the commercial side. as you can see here, there's an inverse correlation as interest rates prices begin to rise. We saw them go up steadily, but as soon as interest rates began to go up, prices tapered off until those owners realized they couldn't sell, and then they began to fall, right? And so that's a correlation, right? And so what you find is in recession resilience, as the debt investor, you're a lot in a safer place where you're more recession resilient because you're away from the volatility, right? Whereas in equity, you're in a more risky spot, right? Because you're feeling every percent of that volatility. And I mean, how does that look on a graph? Well, $10 million property at 60% loan to value. If you drop that value by 15%, that's not crazy. 10, 15, 20, 30% are not out of line right now. But so just a 15% reduction is $1.5 million loss. That's a 37% loss for the equity guys, 0% loss for the debt. So what are we saying here? We're saying, well, you can make money in a downturn or sustain earnings in a downturn if you're lower on the capital stack. It's not that the debt investment's correlated to these things as long as you're low enough loan to value. But what's happening now is you have material shortages, labor shortages, rental assistance ended, you had delinquency skyrocket, evictions, backlogs backed up, and that lost time and delay, you're seeing tons of distress in the market. In fact, Jerome Powell got on just this year saying the stress on the commercial real estate is just beginning to impact the banking system. This is post the big banking collapses that we've heard of. There's still more to go. We're able to charge twice the interest rate that we used to for the same performing assets. So you can get higher interest rates, right, for the same product. So really the opportunity in a crisis time is where you want to look. So the opportunity in crisis time isn't that old school value add stuff that I was talking about above, right? Those syndications. The opportunity right now in common equity and preferred equity, and the equity side, the ownership side, is to buy when it's the right time to buy, when everybody's scared of buying. If you're selling now, it's because you have to. So our acquisitions fund is buying performing assets from financially distressed operators. Our income fund is placing debt. If they want to keep the asset, we can give them a gap or bridge loan, twice the interest rate. So that's how you get high growth in an acquisitions fund in a very short period of time, or a really high cash flow. So you acquire if they need or want out, provide gap or bridge loans if you can't. So that's really the real estate making you return on the buy. But let's get into the non-correlation. So what do you do with cash allocations or your fixed income allocations, right? So if you've exceeded your 27% allocation in real estate, or you've exceeded your equities, your stock portfolio, which is 22% of your, where do you go? What are those lesser known? What are those options that people tend to invest in? And when do you do it? Like, when do you focus, and what do the wealthy do? I mean, why God created economists to make weathermen feel good about themselves. Really, there's two kinds of forecasters, those who don't know and those who don't know they don't know. And that means at any time, you should be focusing on these allocations. You should be looking for the other ways that wealthy people invest. There's a ton of them out there. Really common ones are gold and oil and gas. I invest in both. And there's technology metals, self-storage. There's litigation funding, which we'll talk about in a minute, ATM machines, Forex, Bitcoin. We've done webinars on essentially all of these in an alternative investing series. Parking lots, electric vehicles, coffee. We even did one on bourbon barrel investing. Lots of really interesting stuff out there. Let's talk about gold, for example. This is a good alternative for that 13% allocation in cash or cash equivalents. Why is that? Well, got a lot of cash on the sidelines. You're losing with inflation. And gold is inversely correlated to stocks during a crisis. It's a really good place to be right now. China would certainly agree. They're buying up gold like crazy. And it's inversely correlated to the US dollar. So it's a way to hedge a downturn on your cash or cash equivalent and create growth even in a down market or in a devaluation of the dollar, which is where we're at today. Stores value. They say gold could buy a fine suit 100 years ago, and it can do so today. And you can see this is the gold versus S&P. Gold's high, S&P's lower, gold goes down, S&P goes up, and it's fairly inversely correlated over time. That's what we mean. Does that make sense? Does everybody see that? You're starting to get the feel for what these mean. So here's what the US dollar and gold. Look at this. They hardly ever track each other along the way. So that's a good lesson in non-correlation. So if you're investing in gold, you can feel non-correlated, right? Oil and gas also has non-correlation, provides hedge against inflation and stock volatility. That's why I'm in oil and gas. Now, it's risky, right? And there's lots of ways to approach the industry. Some people don't have the stomach for it, or they don't have enough wealth to really want to take that allocation of risk in oil and gas. So you can invest in working interest, which is direct drilling, provides a lot of ordinary income tax write-offs, very, very attractive for income earners, or mineral rights, which actually our family collects some mineral rights royalties generationally, modest ones, which can provide generational cash flow. You can actually buy cash flow. Now, the really cool is that it's a bit volatile in risk, but it's non-correlated mostly to real estate and the stock portfolio, right? But here's an interesting thing. How many people think gold and oil and gas are correlated? I mean, how could that be the case? How can it be these two completely different things are correlated? Well, they are 80% of the time, actually, and there's the graph to show it. Why? Because these safe haven investments actually are driven mostly by the BRICS nations, and they have market fundamentals. And so this is why it's so important to look at your allocations. You may be like, well, I'm diversified in gold and oil and gas. Well, no, you're not, right? How do you build that resilient portfolio? And over 80% of the time over the past 50 years, gold and oil and gas have been correlated. So now you've talked about some of the more popular ones. What are the non-conventional and non-correlated uncorrelated investments? Those are the hard to find ones, right? Out there that provide that true diversification, true recession resilience, and they often involve industries that show low correlation to traditional asset classes, housing, and energy. So you got to look for things like healthcare. People still get sick in recessions. Education, people continuously need upskilling and reskilling. Utilities, consistent need regardless of the economy, and then legal services. So that is the law industry. Right? How in the world do you invest in something like that, right? And once you find an industry which shows strong recession resilience, steady growth, that balances out the rest of your portfolio, how to figure out how to get into it, right? So let's drill down into the legal industry. Because I mean, things like medical device, you can, when in healthcare, you can invest in medical devices, you can invest in medical receivables. Education, people will invest in trade schools. Legal services, how do you approach that? And why would you want to? What's really interesting about legal services is that it is just a steady, tried and true. Do you see this green line here going across? I created this graph at Fred, along with the others on here. That green line is legal services, just almost straight as an arrow. Look at gold, look at the S&P, look at USD, look at oil, just dancing all around it. It is just a very solid industry, similar to education, similar to healthcare, similar to utilities. And it provides that steady non-correlation to everything else, right? This is the kind of stuff you want to do. This is highly sought after by institutions for this reason. And when you find an asset class like that, you got to figure out how to then approach it. You got to figure out how to invest in it. And oftentimes, just like in real estate, when we provide housing for tenants, well, where's the need in legal services, right? The need is that there are harmed individuals. There are harmed individuals that can't afford to then get their own justice. They can't afford the hourly rates for attorneys, right? And when there's an injustice done or wrong done, we call that a tort. The harm party, which is the claimant, they're staking a claim that they're owed something, or they're making a complaint. Plaintiff is another word. They may seek justice by suing the defendant, right? That's the responsible party. Now, the process of litigation is the process of resolving that dispute between the harmed and the evildoer, right? Through the court system. Super expensive, especially when a lot of individuals, a mass number of people are harmed by this one big bad evildoer. We call that a mass tort, a mass wrong, and brings in litigation funding, also called litigation finance. It's when harmed individuals, they lack the funds. They need the justice. Investors can provide access to justice by helping to fund the attorneys working on contingency. It's not pro bono. It's not doing it for free. You're saying I'll work contingent upon settlement. Mass torts are these big evil doing, acts that are these big evil acts that are done against a lot of people. Those pay out a lot. So investors and lawyers can take some of the profits or some of the settlements, give 60% to the harmed individual, provide a meaningful settlement, and then fund the attorneys and fund the investors along the way. So it's a way that you can access legal services. And it's totally non-correlated. Like we were saying, the outcomes of the cases are not affected by broader markets. Awards and settlements are not you're given to the harmed individuals are not affected by what's going on in your greater portfolio. And it's a really strong, steady industry. It's like medical and education, steady growth. And it's very similar to real estate. It's very similar to our debt fund, for example, where we're giving loans to operators in real estate that have a track record. In litigation service and litigation funding, we're giving loans to attorneys that have a track record. They need to operate their business. They need to be able to pay their guys. They need to pay their guys to onboard additional harmed individuals and pay the hourly rates and court fees to get to the settlement. It's very similar. There's collateral. You get a lien in real estate. We get a UCC1 filing against the contracts that are in place for the contingency fees. Get that collateral can be valued. And just like in real estate, you have a loan to value of 60, 70, 80%. In litigation funding, you have a 10, 20, 30% loan to value. So very safe, very far below any volatility on collected amounts or volatility in the value of the collateral. It makes you have skin in the game. So it's very similar. This is an example of how the very same aspects and concepts in real estate, if you bought your own home and you've got a loan on your own home before, you've literally done all these steps. You've been through underwriting and they've looked at you and they've got a lien on you or your asset. You've gone through all the steps an attorney would go through to get a loan, but they're a completely different industry. Just the names have been changed and the processes are slightly different and tweaked. And you can invest into things like Camp Lejeune. Camp Lejeune is a water contamination where our soldiers went for 17 years, were fed contaminated water, the civilians and their families, and now they're having horrific health conditions such as cancers and birth defects. And the government knew this was going on for 17 years. You can help those that desperately need it, provide access to justice by investing into those individuals. Same thing with Roundup. Salt of the earth, hardest people in our country, spraying pesticides. The EPA, there was false reports saying that Roundup wasn't harmful, and the EPA even retracted the reports that they were lobbied to produce. And now those individuals are suffering from cancer. Our firemen using firefighter foam, military using firefighter foam. They knew it was cancerous from the 70s. There's reports showing 3M, but they kept making more and more products. And then now our firemen are, so again, heroes of our society, need access to justice, and they're getting non-Hodgkin's lymphoma. A lot of these have been settled, or there's, like in the case of Camp Lejeune, there's already a settlement grid. There's a law in place. So this is an example of how you can invest into a completely different industry and get true non-correlation outside of the real estate and the stock market or the volatile commodities. And I guess I want to pause to just check. I didn't really see a whole lot of there's one question here about class action lawsuits. We actually don't do any class action. These are called mass torts. A class action is one lawsuit where a lot of people join, and that's won or lost. Mass torts are hundreds or thousands of lawsuits, individual lawsuits, and it provides a much lower risk approach. There are a lot of a lot of harmed individual diversification instead of them all being in one. How do you know that your attorney will be honest? Well, so you do a diversified litigation portfolio is what we do, David, which means that we do all the same vetting with people that have had skin in the game, track record, operator, multiple partners. They've been investing in these things for half a decade, and they need to get them over the finish line, and they've got a lot of skin in the game. Got hundreds or millions of dollars on the line, and we want to be last in to help them get across. That's how we deal with that. And that's what this slide actually talks about, being very late stage here in the timeline. But Joan, I know you wanted me to stop and try and get some feedback and some questions before the hour's up. And there's obviously more stuff we can talk about.
Yeah, Patrick, I think there's a lot to unpack here, right? This is my first introduction into this topic, and I think my first question is, how do we start learning? I mean, I think it would be foolish to jump in and invest before you did some education. So is that through your so I'll just leave it there. How would somebody start learning about this as an investment class?
Yeah, so we have like a 24 email series, which is Litigation Investing Mastery, which parlays into our Passive Investing Mastery and our alternative investment series. And so if you're interested in our company and you sign up for something, we'll send you our Wealth Accelerator, which provides kind of our take on overall growth and strategies for portfolio. If you're interested in litigation funding, you'll sign up, and once you type your information, litigation funding investment for that series. And Litigation Investing Mastery is specifically for that purpose. It's to bring people up to speed. The challenge that, like I said before, for most investors is learning how to partner. It's wanting to do it all themselves. And the first time I did that, I lost everything in the pre-development before 2009 and 10. The second time I did it in single family, I lost all my time. And it wasn't until I learned to be able to strategize and partner into syndications, real estate, and others that I was able to succeed in a way where I was able to not have to make all the shots and take all the risks and abandon my family in the process. And so by building a healthier portfolio across sponsors and asset classes, you don't have to become as much of an expert. We believe in education, but I just do want to challenge that to have a truly allocated portfolio. Investors don't have to become the operator in each of these asset classes. And that is part of the beauty of it. But we do our best to train and educate as much as we can along the way.
All right. I have more questions, but I'm going to open it up and see if anyone has questions. How about if we stop sharing so I can see the screen? Sure. Does anybody have questions? So a lot of people watch this on the recording. This will go to YouTube, and you'll have that for your thing. Well, if without any questions, and sometimes the questions help people. The questions come after we start having a discussion. I wanted to understand how the fund operates. So I'm in particular not a fan of real estate funds where the fund manager has all the control over what assets to invest the investor's money in, but some funds let you choose your investment within the fund. And I feel that a lot of the funds, especially you're getting a lot of people into funds, and they're spending so fast that they're either not executing the plan, right, getting the value add into the asset, or I think with the big interest rate change, there's just so much work to be done that they got overwhelmed and that they're in trouble. I think a lot of fund operators are in trouble right now. But so how does this particular fund operate?
Yeah, sure. So it's not a blind pool open fund where you kind of see people coming in forever and people coming out forever, and you're not diluted by people that might come in later, that kind of stuff. It's a closed portfolio where we say, hey, look, here's the investments that we're interested in, such as the ones I just shared, and here's the other ones that we have coming up, such as NEC, baby formula, toxic baby formula, Johnson & Johnson talcum powder, cancer issues, some medical malpractice, and some sexual survivor. And here's the nature of these and how they work. And these are what we're going to put in the fund. And so there's more specificity into the target for our products that we're investing in. But just like our debt fund, the real estate asset-backed debt fund, we are specifically looking for a diversified portfolio. And that not only gives us sort of downside risk by being in dozens of different types of law or different types of harmed circumstances, but then hundreds or thousands of claimants. And those that invest in like one deal outside of portfolio investments are taking a huge risk, right? Because maybe that one claimant just has a change of heart and decides they don't want to pursue the claim anymore. We have, just like in real estate, if you have 100% vacancy on a single family home, that means just one person left. It's 100% vacancy, right? I just, like it was for me, I lost my cash flow entirely. Just like in multifamily, you have a 300 unit building, right? Three people leave, that's a 1% vacancy. And so, but through a diversified portfolio, we can be very conservative and underwrite, a claimant fallout rate that is, double or triple what's normal and still be very strong in a similar way. So in order to get that scale, we need to choose a diversified number of types of law, types of cases, lots of defendants, and hundreds or thousands of claimants in those. So it's critical to the strategy.
Okay, and then how is the income distributed and how is it viewed from an IRS standpoint for taxability?
Well, the distribution, so unlike principal and interest payments in a debt portfolio, right? Or unlike cash flow, if you're in equity position, cash flow, where the asset inherently cash flows, right? Either from debt or equity in those two circumstances. Litigation funding is not like that. We don't get a steady Eddie cash flow as a debt investor, and you don't get cash flow because the asset doesn't produce. The operators, like not like tenants, which are providing rent checks. The attorneys are not providing real-time payback. You're giving them the cash they need to then pay their people, right? To then proceed to the settlement. So it's not pushing off cash flow. They're working on contingency, meaning it's deferred until settlement, right? That is more analogous to getting involved in a development project, which has been going on for like 5 years. And we're getting very late stage to where we've got about a year or two, maybe 3 to go to finish. They've got millions of dollars in, they've got track record of doing this. We're going to finish it off. And each of the individual units in this large building, maybe some of them have already sold off. Each of these individual claimants or units, we're going to sell off as we go. No cash flow until we sell them off, right? So each time a case is settled, we have essentially that lump goes through the waterfall of the fund and people participate in a distribution. It's not cash flow, it's distribution. Now those are capital gains. To answer your question, those distributions are capital gains as they come in, long-term capital gains once we, reach that timeline. And part of the beauty of having thousands of individual lawsuits, thousands of claimants, is that although it doesn't cash flow, we have a distribution of payments across. We have a kind of a bell curve of projected distributions across the whole. So it's more middle loaded, right? Because as these settle and you do more and more of these, you have a lot more settling along the nominal than you would have real fast or outlier. And it's about a 7-year row in these mass torts, and we're 3 to 4 years. We're waiting 3 or 4 years for things to be near settling to invest. Does that make sense?
It does.
Mhm.
It does. Does anybody else have any questions? I have notes all over that I was trying to keep up. It was a lot for a first exposure. All right, I want to thank you, Patrick. I think this was this was enlightening, right? That there's other asset classes out there that we can invest in. I'm going to go ahead and end the recording. If
Thank
you'd
you so
stay on,
much
if
for
you
your
would
time.
stay on for a moment.